A basic introduction to credit control. Debtors and income. What are they? A debtor is commonly referred to as your client or customer, and these are typically for revenue or income type transactions. Now let's have a look at the promote, quote and sell cycle. You create a website and give customers information. This is a marketing tool and it comes into play when you talk about promoting your products. There are a lot of other marketing tools out there, but this is just giving you one of the many tools. Next, you may employ salespeople to build relationships with your customers. This is where the sales or the sell part come into play. You need to build a relationship with your customer or clients, usually before you can sell to them. After that relationship is formed, the salespeople provide quotes. Again, this is where the sales come into play, and particularly the quote. Customers place the orders, and this is known as customer service. So this is now where they've received the quote and they're happy to proceed and purchase the product from you. With all of this in mind, you spend money on operations to store and deliver your products to your customers. Again, this is where customer service comes into play. This is also a behind the scenes process, and your customers will not see this happen. You then give credit terms to make it easier for customers to purchase from you. And these credit terms are known as accounts. And that is the cycle of promote, quote and sell your products and services. Let's take a quick look at the debtors report. A debtors report is also known as an accounts receivable, or commonly known as well as an AR report. It typically shows the reader whom owes money to your business. So it shows you what is outstanding, how long it has been outstanding, and of course to which customer this applies. Let's take a look at the flow of cash and assets cycle. So this is a general cycle and it will fluctuate depending on your individual business, but this is a basic guide. You obviously need to start with the cash at your bank. When you have that cash, you can then purchase your stock. When you have received this stock, you can then sell the stock and invoice onto your customers or clients. And what comes next? You can then offer payment terms to your clients. They can accept those payment terms, or they could choose to pay on the spot, which is also known as cash on delivery. And then, of course, you would receive your money. So that is the basic flow of cash and assets. But how long does all this take? The faster you can go through this cycle, the more money you can make. Let's have another look. Again, we have the cash at your bank. Then we purchase stock. Then we can sell stock and issue an invoice to our customers. And of course, your invoice is paid. Now these 4 processes are all relating to an asset account in your chart of accounts. So the cash at bank is commonly a current asset. The purchase of stock is an inventory asset. When you sell the stock and issue your customers an invoice, that is known as an accounts receivable asset. And then, when your invoice is finally paid, it is then transferred to a current asset. And that cycle can then just go on and on. And again, the faster you can go through this cycle, the more money you make.